In this lesson, we're going to identify the fourth order type, the stop limit order. We'll show you what it does, then tell you why it's the most dangerous of the order types and you probably shouldn't use it, or at least not yet. A stop limit starts off very similar to a stop market order. It asks the question, has the stop price been hit? If not, then nothing happens. If it has been hit, the system will send an order to close the trade, but it does it with a limit order in an attempt to limit slippage, and this increases risk. We'll show you an example here in a second. A stop limit order is triggered at a specific price, and once it's triggered, a limit order is placed to enter or exit the position. A stop limit order is more complex than the other order types. For one, it's more difficult to enter into the system, and two, it carries some risk. That's why it's typically only used by more experienced traders. The good thing about using a stop limit order is that since it's a limit order, you may get filled at a price better than what you anticipated. The bad thing is that you may not get filled at all, which makes it dangerous to use as a protective stop. For stop losses, your best bet is always a stop market order. Let's look at an example of why using a stop limit is a bad idea. On the chart here, let's assume that the trader is long and wants to use a stop limit to protect their trade. On the order bar, they first put in the trigger to send the order, which is the stop price. Here you can see that the price is $112.31. Next, you put in a limit price, which tells the system to not sell for less than a specific price. In this example, that specific price is $109.50. Look at what happened the next day. The stock gapped down beyond the limit price of $109.50. Remember, since the price is below the trigger of $112.31, the order will be sent to sell. However, we also said not to sell for less than $109.50. So while price jumped to below $90, we would still have the position and be taking larger losses. The moral of the story: don't use stop limits for stop losses. While we don't recommend using a stop limit order to exit a position, once you know what you're doing, you can use it as a confirmation entry, which does seem a little counterintuitive to its name, the stop limit. Recall, however, there are three types of entries: the proximal entry, the zone entry, and confirmation entry. In the example, we're not using a stop limit order as a stop loss, but rather as an entry tool for buying long. And here's how. Looking at the chart, we can see that the price came down into the identified demand zone. If we want to enter a trade going long on a confirmation entry, we can do it with a stop limit order. Once the price is below the price that we want to enter at, in this case it's $34.30, and we want to buy at $34.31, we can use a stop limit on the order bar. The stop limit sets two prices. The first is the stop price. That's the price that we want to pay, $34.31. The second is the limit price, the highest price that we are willing to pay. In this case, the limit price is $34.33, which allows for 2 cents of slippage, since we know that's a possibility as price moves up. Once we submit the stop limit order, if price moves up to $34.31 and confirms that it's leaving the demand zone, a limit order is sent telling the market that we're willing to buy the security at no more than $34.33. That's how to use a stop limit order as an entry tool. Again, we strongly recommend not using a stop limit order as a stop loss because it can potentially gap over your stop price. Now let's look at using a stop limit order to enter a short position. In this example, the price has rallied above $34.34 into our identified supply zone. Our strategy is to use a confirmation entry once price leaves the zone. We can use a stop limit on the order bar and enter the price we are willing to short the security. In this case, $34.33, just below the proximal line. We then set the limit order to $34.31, again, telling the market that we won't accept more than 2 cents worth of slippage. Once we hit that sell short button and submit the stop limit order, if price moves down to $34.33 and confirms leaving the supply zone, a limit price is set at $34.31. It's a way to wait for price to leave the zone and sell with a confirmation entry. So now you know what a stop limit order is, why you should never use it as a stop loss, and how, with a little more experience, you can use it as a confirmation entry to buy into or sell shares short. Before you move on, what and how are stop limit orders used for entering and exiting a position? Also, ask yourself, what are the positives of using a stop limit order and what are the negatives of using a stop limit order? Hope to see you in the next video.